Right now, there's a trade that could force $2 trillion in automatic selling. And the trigger isn't a crash, it's the absence of one. It is sitting quietly inside US brokerage accounts, built one borrowed dollar at a time. Economists call this a margin cascade. One round of margin calls forcing selling that triggers the next round automatically. The easy story is reckless retail traders piling into meme stocks again. Except the top 10% of earners hold nearly a third of national income per World Bank data. It's disproportionately their leveraged accounts moving this market, so it actually turns a record pile of borrowed money into a forced self-feeding unwind, and who is left holding the loss. Start with where the record actually sits. FINRA data reported by CNBC puts margin debt in US brokerage accounts at roughly $1 trillion in 2026, an approximate figure but still the highest level ever recorded. Track the run-up to get there: $381 billion in 2007, a crash to $182 billion in 2008, a rebuild to $479 billion by 2020, a spike to $935 billion at the 2021 peak, a cool down to $680 billion in 2022, and now back above every prior high. Scale that against history one more way. Today's balance runs close to 2.5 times the 2007 peak that everyone in hindsight agreed was reckless. This is happening against a backdrop most people would call calm. GDP growth in the US ran at 2.16% in 2025 per the World Bank. Unemployment sat at 4.2%, also World Bank data, a level central bankers usually treat as fine, not alarming. That calm is exactly the problem. Cheap confidence is how leverage gets this big in the first place. If margin debt effectively doubled through compounding options and derivative exposure, the hypothetical systemic exposure could approach $2 trillion, larger than the annual output of most G20 economies outside the top 10, and equal to roughly 6.5% of America's entire $30.77 trillion GDP per World Bank figures. Put that next to Washington's own math. The federal deficit this year alone runs near an estimated $1.8 trillion based on approximate CBO projections. A private unwind anywhere near that scale would land on an economy already carrying that public tab. Margin trading works like a homeowner taking out a second loan against a house to buy more of the same house. Prices rise, the collateral looks great, so the lender extends more credit. That is fine, right up until the appraisal drops. Here is the actual mechanism, and it is the trigger the opening question was really asking about. When a stock's price falls, the loan-to-value ratio on the margin account breaches its limit, and the broker issues a margin call. Pay up immediately, or the broker sells the position for you at whatever price the market happens to be offering. It does not wait for a bad week. It moves inside a single trading session, sometimes inside a single hour. None of this shows up on a stock ticker. It shows up in a data series almost nobody outside a trading desk has ever opened. That is, until now. Every month, the Fed holds interest rates steady. Another month gets added to how long this leverage can keep building. That steadiness is not free. It is quietly financing bigger and bigger positions. Cheap, predictable borrowing costs are exactly what let $1 trillion pile build without anyone sounding an alarm. The cretch did not get reckless overnight, it got reckless one calm month at a time. That is the part a backward-looking chart never shows you. It shows the size of the pile, not the runway that let it grow this long. Layer retail options activity on top of that margin debt, and the exposure compounds again. Zero-day and short-dated options force dealers to hedge by buying or selling the underlying stock in real time, so a wave of options expiring the wrong way can trigger the same kind of mechanical selling a margin call does, just through a different pipe. Brokerages and financial press describe trading volume on these products as running near record levels through mid-2026, per figure cited by Yahoo Finance. Two leverage channels, moving the same direction, are harder to unwind cleanly than one. Why is the pile this size right now specifically? Inflation cooled to 2.95% in 2024 by World Bank measures, and the latest inflation ratings have reportedly bought the Fed more room before its next move, according to CNBC. So the Fed has held its benchmark rate steady through much of 2026 rather than cutting or hiking, based on Fed communications covered by CNBC. That steadiness reads, to most traders, as safety. It is actually runway. Call it the leverage runway. The longer borrowing stays cheap and predictable, the more debt accumulates before anything forces it back down. Everyone is boarding the same runway at the same time. Nobody is measuring how long it actually is. The number that ends a runway like this is the contraction rate once forced selling actually starts. Last cycle's answer was a fall of more than 25% inside months. What that percentage does to today's $1 trillion balance is next. 27%. That is roughly how far margin debt fell from its 2021 peak of $935 billion to $680 billion in 2022, according to FINRA data reported by Reuters. Apply that same contraction rate to today's roughly trillion-dollar balance, and you get somewhere north of $250 billion of forced stock sales, compressed into months rather than years. And that is the mild precedent. The 2008 unwind was not a slow bleed, it was a demolition, with margin debt collapsing by roughly 50% from its 2007 peak within about a year, according to historical FINRA-based analysis cited by Bloomberg. Major indices lost double-digit percentages within a 2-week span as forced liquidations fed on each other, according to Wall Street Journal reporting from that period. One broker's margin call forces a sale. That sale drops the price further. The lower price triggers the next account's margin call. Same as the second mortgage, the lender does not wait for a good time to sell, it just wants its money back. Nobody plans this. The math just runs itself. There is a second layer of exposure most coverage skips. Prime brokers and clearinghouses sit between the trader and the market, and they claim their collateral first before any loss reaches the client's own equity. That is why a margin cascade rarely stays confined to the stock that triggered it. Brokers often liquidate a client's most liquid holdings first, regardless of which position actually breached its limit, just to raise cash fast. A shock in one crowded trade can bleed into completely unrelated ones inside the same afternoon. So who actually eats the loss? Not evenly. The top 10% of US earners hold 30.7% of national income per World Bank figures, and leveraged trading, margin accounts, options, futures skews even more heavily toward that same wealthier, more active cohort. US GDP per capita rose from about $65,228 in 2019 to roughly $86,170 in 2024, a 32% nominal jump per World Bank data, and that rising cushion is part of what let households take on more market risk to begin with. The people carrying the most leveraged exposure are, on paper, the people best equipped to absorb a hit. Margin calls do not check your balance sheet, they check the price. That means the same wealthier households carrying the heaviest leverage are often the first to face forced sales at the worst prices, compressing years of gains into weeks, and retail accounts get liquidated at the very same market open as institutional ones. Brokers get made whole first, by contract. Everyone downstream of them gets whatever price the forced selling has left behind by the time their order fills. That is not an accident. It is how a margin agreement is written. Layer the public balance sheet under all of this, and the picture gets worse before it gets better. Federal government debt reached 115.77% of GDP in 2024, up from 100.2% in 2019, a 15% jump in 5 years, per World Bank figures. That means the government itself now carries more leverage relative to its economy than most of the over-leveraged traders regulators keep warning about. US Treasury and CBO data show total federal debt held by the public still climbing through 2026 with no plateau in sight. So the backstop that absorbed the last two unwinds is itself more indebted than at any point on record. None of this happens apart from the banking system either. Banks and prime brokers extend much of the credit behind margin accounts, and a fast enough cascade tests their balance sheets right alongside the government's, the same way it did in 2008. If a $2 trillion scale margin cascade hit while the Fed is mid-hold and the deficit is running near $1.8 trillion a year, per CBO estimates, there is less fiscal slack available to cushion it than there was in either 2008 or 2021. Faster leverage, a larger base, and a government carrying its own record debt load. That particular combination has never actually been tested at today's scale. Nobody knows exactly how it resolves until it happens. It would be easy to stop right there and leave the outlook grim. But 2 of the last 3 unwinds were actually contained, and contained on purpose. In 2020, the Federal Reserve opened emergency lending facilities within days of that crash, and by the Fed's own published record, equity markets, and the margin debt collapse riding alongside them, mostly recovered within about 5 months, not years. Exchange-level circuit breakers, introduced after the 2010 flash crash, have halted trading multiple times since, specifically to break a selling feedback loop before it fully cascades, according to Reuters reporting on their use. FINRA itself tightened margin requirements after the 2021 episode, which is part of why that unwind stayed a correction rather than a crisis. Think of these tools as new appraisal rules on that second mortgage. They do not stop the loan, they just slow how fast the lender can act on a bad appraisal. None of them stop leverage from building in the first place. They just shorten the distance between a shock and a stop. So where does this actually go? The Fed holding rate steady is not reckless by itself. Cooling inflation at 2.95% gave it room to wait, per World Bank and Fed data. But every month it holds without tightening the leverage rules underneath it is another month added to the runway, not a month subtracted from the risk. Whether the next unwind looks like 2021's orderly 27% correction or 2008's 50% demolition likely comes down to a narrower question than most coverage admits: does anyone tighten margin standards before the shock or only after it? History's answer, so far, has been after. And because leveraged exposure concentrates among the same wealthier, more active households counted in that 30.7% income share, a badly timed unwind would not spread evenly. It would hit hardest exactly where the borrowing was heaviest. The real choice in front of the Fed and brokers right now is whether to slow the leverage before that happens or clean up the wreckage after. We opened with $1 trillion sitting quietly in America's brokerage accounts and a $2 trillion shockwave sitting behind it. The first number is already real. The second is still a choice: slow the leverage now or clean up the wreckage after. Thanks for watching. Mind your reserves. This video is for educational purposes only and is not financial advice.